Hi everyone. On March 23rd, 2026, something happened to SCHD that most investors have not fully understood yet. SCHD just completed its annual reconstitution. The fund you owned before March 23rd is not the same fund you own today. 25 companies walked in, 22 companies walked out. 8% of the entire portfolio shifted in a single day. By the end of this video, you will know exactly what changed, exactly why it changed, and exactly what it means for your income and your future. Hey, welcome back. This is SCHD, where we turn big financial ideas into simple steps anyone can act on. Nothing here is financial advice. Always consult a licensed professional before making any investment decisions. Let's get into it. Here is what makes this fund different from everything else. Since SCHD launched in 2011, it has delivered 12.9% annualized returns, while paying quarterly income the entire time. That track record was built across two full market crashes, a global pandemic and multiple recessions. It did not happen because of luck. It happened because of a process, and that process just ran itself again. Most investors think reconstitution is routine housekeeping. Swap a few names, move on. That thinking is expensive. Reconstitution is the most powerful feature SCHD has. Every year, every holding gets run through a strict quality test. 10 consecutive years of dividend payments minimum. Strong free cash flow to debt. High return on equity. Competitive yield. One failed screen and you are out. No exceptions. No sentiment. But here is what most people miss entirely. After running those quality screens, SCHD ranks every eligible stock by dividend yield. And only the top 50% qualify. When a stock's price rises sharply, its yield compresses. It falls out of the top 50%. Gone. When a stock's price drops, its yield rises. It moves up the rankings. Added. Every single March without emotion, SCHD is automatically selling what surged and buying what was beaten down. That is not guessing, that is a machine. Wellington Management studied this exact behavior across nearly 100 years of market history. They divided dividend stocks into 5 groups based on yield level. The results surprised most people. The second highest yield group, the one that is high but not the very highest, outperformed the S&P 500 in 7 out of 10 decades from 1930 to 2024. Not the highest yield chasing the biggest payout. The quality yield, the sustainable yield. That is precisely what SCHD targets, every year automatically. Here is exactly what happened on March 23rd. 22 companies were removed. The biggest names, Cisco Systems, AbbVie, Valero Energy, Halliburton, CF Industries, also out, Packaging Corporation of America, LyondellBasell, Ovintiv, Amcor, Unum Group, Whirlpool, Signet Jewelers, and several smaller financial names. These were not failing businesses. They simply no longer ranked high enough against the available alternatives. That is the process protecting you, not punishing them. 25 companies were added. The headline names: United Health Group, Abbott Laboratories, Procter & Gamble, Qualcomm, Accenture, Comcast, Automatic Data Processing, Blackstone, and Ares Management. You will see the full list on screen. Everyone cleared the same rigorous 4-factor test. Here is how the sector picture changed. Energy dropped approximately 8%, from around 20% of the fund down to roughly 16%. Healthcare gained about 4%. Technology gained about 3%. Materials and chemicals dropped around 3% with the removal of LyondellBasell, Amcor, Huntsman, and FMC. Consumer staples picked up roughly 2% with Procter & Gamble entering. Financials gained modestly with Blackstone, Ares, ADP, and Broadridge joining the fund. The numbers that matter most: dividend yield holds an approximately 3.5%. 10-year dividend growth rate confirmed at 10.99%. Assets under management, nearly $100 billion. Expense ratio, 0.06%. These did not weaken. They held or improved. Here is the part that will divide the comments. The 2025 reconstitution pushed energy above 20%. Most analysts called it a mistake at the time. That bet paid off completely. Energy led the market heading into 2026, and SCHD dramatically outpaced the S&P 500. Now, the same process is doing something that feels wrong. It trimmed what just won and bought what was beaten. The new additions fell an average of more than 20% over the past year before entering SCHD. The stocks removed had gained an average of nearly 27%. Sell the winners, buy the beaten names on purpose. Every instinct says follow the winners. Every instinct says avoid the fallen stocks. Here is the uncomfortable truth. The investors who follow these instincts in moments like this are the same ones who consistently underperform. SCHD's 12.9% annualized return since 2011 was not built by chasing what just worked. It was built by this exact discipline. Buy quality when it is cheap, remove it when it gets expensive. Repeat for decades. There are 3 things every SCHD investor needs to take away from this. First, your income just became more predictable. Energy dividends move with oil prices, which moves with wars, weather, and political decisions nobody can control. At 20%, that unpredictability was inside every quarterly payment you received. Now your income sits more heavily in healthcare, consumer, and financial businesses, companies people pay regardless of what the economy does. That matters, especially if you're building toward retirement income. Second, SCHD bought quality at a discount. United Health Group enters after a painful price decline, now carrying a dividend yield it has not seen in years. Abbott Laboratories enters after a difficult stretch. Procter & Gamble, one of the most reliable dividend growers in American history, is now inside your fund. The process does not buy these names because they are popular. It buys them because the numbers qualify and the price is right. Third, the dividend quality of the fund got measurably stronger. The new additions carry a healthier average payout ratio than the stocks removed, and the median 5-year dividend growth among the additions is dramatically higher than what left. SCHD did not just shift sector weights on March 23rd, it upgraded the quality of your income stream. Most investors will watch this, understand it, and do nothing. A smaller group will recognize what actually happened. SCHD quietly ran the same process it has run every March since 2011. It sold last year's winners near their peaks. It bought quality names near their lows. It upgraded the income stream. And it did all of this automatically without emotion at a cost of 6 cents per $100 invested. Wellington Management's data covers nearly a century, 7 out of 10 decades. The quality dividend approach beat the market. Not because it was exciting, because it stayed disciplined when everyone else got emotional. Your job is simple. Stay consistent, keep buying, keep reinvesting, let the process work. This video is for educational purposes only and not financial advice. Always do your own research before investing. If this video changed how you think about SCHD, hit like and subscribe. Drop your answer below. Are you buying more SCHD after this reconstitution, or are you watching to see how the new holdings perform first? That conversation belongs in the comments, and I will see you in the next video. Smart investing, profitable results.